What if I told you that thousands of federal employees have become TSP millionaires using the exact same three-fund strategy? In this video, I'm going to break down the updated TSP strategy for 2026, how the C Fund, S Fund, and I Fund are performing this year, and the exact allocation that I'm personally using right now. When I first joined in 2008, I really had no guidance on the TSP, right? In fact, that first 8 years that I served, my fund sat in the G Fund, which is like government-backed securities and the lowest. It doesn't lose money, but it barely keeps up with inflation, if that. And so I was contributing to the Thrift Savings Plan while earning a very minimal return based on my lack of understanding of how to use the funds. And I'm hoping to help you avoid that, because I remember thinking, man, if somebody had just sat down with me and said, hey, switch this to there, I would have 2 or 3 times what I currently do in the Thrift Savings Plan. And boy, would that be nice. The biggest trap for the TSP is leaving money in the G Fund. It just is what it is. The G Fund's great if you're like close to retirement and you're looking to be very, very, very conservative. It is not great for actually building wealth. That is where the fund used to default. In 2020, that changed to your Lifecycle funds, which is better, not necessarily perfect, but probably the right answer if you don't know what you're doing. The second biggest mistake here is timing the market. There are these Facebook groups out there that try to like move your funds from here to here to here to here. And they're like, oh, look, we beat the market by like 2%. Timing the market is just a fool's play. Like it just isn't the move. So like set it, forget it, long-term strategy, look at it once a year. Don't stress your Thrift Savings Plan. In my opinion, way better than like constantly stressing about where it is to maybe earn 1% more, barring any fees for moving stuff or whatever. And what if you're wrong and you lose and you spend all this extra time on it? The third is overcomplicating allocation structures by like trying to do all kinds of crazy things, like just use the Lifecycle fund and let it automatically adjust if that's what you're going to do. And the fourth is not increasing contributions. Like if you just set it at the bare minimum, that's fine. It's better than nothing, but like increase your contributions over time. You know, every time you get a pay raise or a promotion, up your TSP allocation by 1 or 2%. You're still getting some extra money in your bank account, but you're also contributing more and more and more to your Thrift Savings Plan. And before you know it, you'll be putting 30% of your paycheck in there and you won't miss a dollar of it because you'll never have seen that money into your bank account. For those who don't know, the Lifecycle funds that I've mentioned a couple times are essentially just the Thrift Savings Plan coming up with their own conservative strategy. And so at the beginning, like as you're young, like let's say you plan to withdraw in 2065. Like if you were born in 2000, you plan to retire in 2065, that's at 65 years old, around when you would be retiring anyway, right? And so it'll be really aggressive when you're like 20, and it'll slowly migrate to more conservative as you get closer to 65. So it'll be the G Fund will slowly grow, the other funds will slowly decrease. And that is common, you know, wealth strategy, wealth preservation. Like you want less risk as you're older and more risk as you're younger. You know, more risk, more return, younger, less risk, but also lower return when you're older because you're actually going to be needing that money and you don't want to be on big ups and downs, right? That's kind of the idea. So if you do no homework, no research, the Lifecycle is probably the best bet. Yes, anyone who's going to hear me say that and freak out, you 100% can outpace the lifestyle doing this your own. But if you're not going to take the time to learn how to do it, then just let it be done by the pros. You'll earn a little bit less, but it's fire and forget. If you're dabbling without any understanding, the likelihood is you do way more damage than good, right? Because what if you get all these great returns and then you forget to take it out and the market tanks and now you're... Brief overview. The C Fund, which is one of the more common ones, tracks the S&P 500 and the largest companies in the US. Now, the S Fund tracks smaller US companies and it's a little bit more volatile, but the C and S Fund are both still the US economy stocks by large. And then the I Fund is international stocks, which again, volatile, fluctuates, you know, not necessarily. So like, that's why I like to lean CS, because I like to bet on the US economy, because if it goes to crap completely, then like I'm kind of in a hurt locker anyway. As a real quick overview, I'm going to look at this and I'm just going to lay this out to you. Over the last 12 months, the C Fund returned 16.3%, the S Fund 8.6%, and the I Fund 35.3%, which is huge. But if we go out over the last 10 years, the C Fund 14.8%, the S Fund 11%, and the I Fund 8.7%, which is why it's easy sometimes to look back over the short term and be like, oh my gosh. But like, you want to play the long game here. Your TSP is a 30, 40, 50-year investment strategy. And so that's why I like the C fund, because it has historically been more stable, and the S fund historically been more stable. And I like a little bit of the I fund because it's volatile, but you don't want to like overdo it, because that same 35% over the last 12 months would have cost you 6% against the C fund over the last 10 years. So even though right now it's huge, over the duration, you would have lost significantly. Personally, I am currently sitting at 75% C fund, 25% S fund, 75 C, 25 S. Another point in time, I was at 70% C fund, 20% S fund, and 10% I fund. And so in this situation, what I would do with that is that 10% I fund that would have blown up 35% over the last 12 months is probably now 15 or 16% of your portfolio, because it expanded quickly. So it takes over some of your overall market share. And the temptation then is just to leave it. But what I would do is at that 6-month or 1-year check-in, when I'm looking at my funds, I would actually reset it. So I would take the 6% or whatever that is when you went from 10% of your fund to 6, and I would take that and migrate it into the more stable long-term. So I stay at 70, 20, 10. Hope that makes sense. So I'm just kind of rebalancing to the structure that I want. So as the I fund blows up, you pull money out into the other ones. And as if the I fund has a really bad year and it tanks, it'll kind of just refill on its own, or you can migrate some funds over there to kind of dollar cost average. Because what happens is, let's say that one plummets and you take 2 or 3% out of your C fund and move it over there. The idea is that will go back up eventually. And so you're kind of playing this game where you want to stay. It is, in a sense, I suppose people think timing the market, but it's really just staying on a balanced percentage, whether that's 75-25 split or 70-20-10. Those are my two preferences. You're trying to stay in that realm so that as it goes up and down, you're still dollar cost averaging into that same strategy. And over time, you will win. This is kind of like the barbell strategy that Nassim Taleb talks about, where it's like, you want a very small percentage of your portfolio to be aggressive, and then when it goes up, you pull it back into the normal section that's very stable. As an example of how the long-term perspective works out, C fund has averaged 15% return per year over the last decade. Let's say that maintains. Now, I'm not saying that's going to be something that can maintain permanently, because that is a little bit higher than the average standard, or than the standard, national return. But let's assume that you got 15% for the next 30 years. If you put $500 a month away, that's $6,000 a year, which would be $180,000 that you have contributed at the end of that 30 years. But that $180,000 would have grown to about $1 million with that return compounding time over time over time over time. So this is why playing the long game matters with your thrift savings plan. So you should watch my other videos on how to use it and be investing right when you leave for the service. Start right away. The dollars you invest at an earlier age are worth absolutely more than the dollars you invest at a later age trying to play catch up. As I've mentioned, I play between two different strategies depending on how I feel. 75-25 split or 70-20-10 split, and that's CS or CS and I. That's it. Now, there are a million different strategies, but people ask me about mine, so now you know. That's where I leave it. And on my index funds, I basically do the CS split anyway, which is a Vanguard VTSAX, which is a total stock market index fund, meaning the entire US economy. So I pretty much play this game all in right now. Now, in the past, I did have some international funds or some I fund. I don't currently. Not to say that there's anything wrong with those. It's just not where I'm currently sitting, and I just don't necessarily care to change it because it's working and it's stable. Here's the deal. The real, sexy get-rich-quick strategy with the TSP isn't any of that. It's just consistency over the long term. It's picking a strategy, dollar cost averaging, meaning you're contributing the same amount every month, and over time you slowly increase the amount that you're contributing, which is your percentage that goes into the TSP. So start at 10 or 20 and then up at 1 or 2% every time you get a pay raise. And as that increases, that's all it is. That compounding for a long period of time equals a very significant amount of money in your account. The Thrift Savings Plan, TSP.gov, has a really decent calculator for how this could work out using past performance. Now, past performance is not necessarily indicative of future success, but it's a better indicator than guessing, right? Because you can, not in the short 12-month period, but in the longer 10, 20, 30-year scope, you can get a way better idea of how your funds are going to perform and invest accordingly. So, first thing, at least invest to max, like to get the match for the TSP, which is 5%, but I would say 10 bare minimum, 20 if you're awesome. Slowly increase that every time, pick an allocation and let it ride. Now, I will tell you this, as you get closer, like when you get to like 40 or 50 or 60, you're going to start wanting to think about a little bit of G fund. So and this is going to be up to you and your risk tolerance. Like I said, you could do the life cycle if you want to be simple. Maybe at 40, you give yourself 5 or 10% in the G fund. And at 50, you make that like 20 or 30% in the G fund. And at 60, you maybe probably move that to like 50% in the G fund. Up to you, right? But as you get closer, you're going to want more and more in the G fund so you don't take a hit if the market dips. If you want to know more about the basics of finance and investing, I've got a free military finance course, so I'll drop the link in the description for that. Also, if you haven't yet, go to Amazon or Audible and snag a copy of my book. It's a best-selling. It's everything I wish I'd known when I first joined the military, the No BS Guide to Military Life. We also give it away for free. There'll be a link for that in the description. But, if you like a hard copy or you like listening on audio, I narrated it myself. They're both there. We'll leave you QR codes, and hope you got something out of this. Comment how you're using the TSP, or if you have TSP questions that you'd like me to answer on one of my lives that I do on Thursdays, drop those in the chat as well.